The investment philosophy at Shone Asset Management actually starts with the asset allocation. What's the portfolio going to look like? Broadly, how much in stocks, how much in bonds, how much in cash? It's more detailed than that, but that's the broad approach. After we decide what that allocation is going to look like, then we want to make sure we implement in low-cost, tax-efficient structures so that we can get the most bang for our buck out of the underlying investments that we're selecting. Many times when someone comes and sits down with me, they try to focus a conversation around whether something's a good investment or a bad investment, or if I have a good portfolio, or does the portfolio look like there's something wrong with it. And we always take a step back, because I don't think there's necessarily a thing such as good portfolios and bad portfolios per se, but there are portfolios that don't match what you're trying to accomplish, and there's portfolios that do match what you're trying to accomplish. So we always start with, what's the goal? What's the objective here? Dealing with time frame, how much risk you're willing to take to get to that goal. Doing that work, doing the planning work, will lead us to a range of potential portfolios that will help you accomplish your goals. That allocation is going to determine 90% of your performance. So we want to get that right to begin with. And we want to match it to your risk. Risk is how much downside, the important part of risk is how much downside are you able to take on before you panic and say, I've got to get out. That's the biggest danger. That's the thing we're trying to avoid the most, because the math says that markets earn a much higher percentage than the average investor does because of behavioral issues. So what we want to do is we want to make sure that a portfolio that we know will help achieve your goals is also something that you can tolerate on a day-to-day basis. We also have to pay attention to how the assets are owned. What assets do we want to own in tax-qualified accounts like IRAs and 401ks versus what type of assets do we want to own in taxable accounts, things that you might spend earlier, or things that create taxation every year if you're not monitoring that carefully. So asset location, how we go about placing investments in a variety of portfolios, makes a big difference in long-term results for clients. There are a couple of things that will change the portfolio over time. One is if your goals change. That will be a change. Two is if our underlying managers that we've selected on your behalf are not doing what they're supposed to do, then we'll make a change. The third thing is if we move outside of those rebalancing areas, then we're going to make a move to get that portfolio back in line, back into place. So after we implement that portfolio, it's not set it and forget it. We have to do some things over time, and it's often talked about in this business about rebalancing. Rebalancing, a lot of people will say we do this quarterly, we do it annually, we do it when we meet. There is nothing magical about March 31st, June 30th, September 30th, or December 31st. Those are dates on the calendar. So what we want to do is we want to set up rules-based rebalancing, and we set bands around portfolio positions. When portfolios move outside of those bands, that's when we make our move to rebalance. It's not based on a calendar. It makes a lot more sense. When we're investing portfolios and monitoring portfolios here at Shone Asset Management, we are not paying attention to the yelling and the screaming on TV, the headlines in the newspaper. It's important to employ a process